We are so excited to be joined here today by my former colleague, Matt Hornbach, who is global head of macro strategy at Morgan Stanley. Matt has a 30-some-odd-year career working at Morgan Stanley across both strategy and trading. So we're so excited to have you on. This is the day after the FOMC. So we just had our first rate cut of 2025. And I'd love if we could get into your reaction, your analysis, and everything that's going in the markets before we talk about kind of the bigger macro picture and also talk about what it means to work in macro strategy, what the lifestyle's like, all that fun stuff. So we're going to start with the markets, and then this is kind of like an upside down episode relative to our usual content. We're going to start with what's going on and then work our way back.
Yeah, that's great. Well, thanks for having me on, Jen, and thanks, Kristen. It's nice to meet Kristen. Great to see you again, Jen. Yeah, I mean, I love talking about macro and the Fed, so I'm happy to start there, and then we can get into my career and all of the different places I've been. And I was just in Dubai actually earlier this week, so I've
As
been
one does.
I go around quite a bit. But the Fed, I think was an interesting one. Going into it, one question that investors were asking was about the dissents that we may or may not see. And the idea was that last meeting we had a dissent by two Fed governors, and the idea was if they felt strongly about cutting rates at the last meeting, the intervening data was weak on the labor market side of the ledger, and I would say even there was a downside surprise to all the translations into this upcoming core PCE inflation number. The idea was if they felt strongly about cutting rates at the last meeting, surely they would dissent in favor of a 50 basis point rate cut at this meeting as a makeup to what they did not get at the last one. So the fact that there was only one dissent and it was from the new Fed governor, Stephen Miran, that was a shock to, I think, a lot of investors. And that really set the tone for the price action that ended up following. Now, the immediate reaction in the market was to realize that actually the median dot did show 75 basis points worth of rate cuts for this year. I think the consensus was probably leaning more towards only 50 basis points. So the fact that the median dot did, in fact, just go down to 75 basis points was the very first thing that people keyed off of. So you get a little bit of a bond market rally, a slight bull steepening of the yield curve. But then as people made their way through the materials, they realized that it did go to 75 basis points for this year, but it was on a razor's edge. And we actually didn't get either Governor Bowman or Governor Waller dissenting. People started to, I think, look at the whole package as a bit different than maybe what that initial dot would have suggested. Then you start looking at the forecasts that they put together, and they come off as a bit on the hawkish side of the ledger. So I'll give you a perfect example, something that I was scratching my head about, and I have a certain take on this, but you look at the projection for the unemployment rate in the fourth quarter of 2025. So, for most of the information in the summary of economic projections, they give you the numbers on a Q4 over Q4 basis, except for the unemployment rate. The unemployment rate they give you as an average for the fourth quarter of that given year. And so you look at the median forecast for the average unemployment rate at the end of this year, and it's 4.5%, right? So the current unemployment rate is 4.3%. If they're saying that the average in the fourth quarter is going to be 4.5%, it could mean that the actual unemployment rate for the month of December, which we don't get until January, it could be 4.6. And so if we actually get an unemployment rate that averages 4.5% in the fourth quarter of this year, to believe that the FOMC is going to gather in December and then write down only one more rate cut in 2026, it's hard to fathom, right? It's hard to fathom getting to December. The unemployment rate has really gone up. It's hard to fathom them sitting there and thinking, we probably only need to cut once more. That just
Well, and
doesn't.
I think that ties into Powell's comments that seemed to have spooked the markets during his press conference, which were, this is a risk management cut, and we're going to take things on a meeting to meeting basis. I was joking with Kristen that this sounds like a doctor with terrible bedside manner. Like, hey, good news. This treatment's going to keep you alive for today. Let's see how you do next week. It's like, wait, that wasn't what we thought when we were looking at these projections. It's like 3 and done, going to be a soft landing. And then the tone seemed very different in the actual press conference. So
I feel like it's almost worse than that, because it's like someone comes in for like a mental health issue and you're like calming them down. And then like whatever you tell them actually like gets them like spooked again. Because so much of it is like the expectation and like the sentiment. So it's like, it's the doctor, but it's like the doctor who's trying to like help make someone less anxious. And then they're like, but actually like you might die. You're like, ah. So
That's so right. I mean, there was a string of FOMC meetings where the statement gave you one vibe and the presser gave you a totally different vibe. And it was like back and forth for several meetings where, the statement's dovish and then Powell is hawkish. And then the next meeting, the statement is hawkish and Powell is dovish. And it went back and forth several times. And, in some ways, I think that's just sort of the yin and the yang of this balancing act that the Fed has had to perform for the better part of 2.5 years now. Powell did talk about this several times where we're in a very unique situation, where the inflation rate is above target. Although, in fairness, it's not dramatically above target, right?
It's always above target.
I mean, it's so funny because after the great financial crisis, the Fed went through all sorts of policy innovations, despite the fact that the inflation rate was averaging 30 basis points, 40 basis points below target. And because of the inflation rate was below target, but by 30 or 40 basis points, it was almost nothing, that we got all of these QE episodes, right? We got all of these unconventional monetary policies for 30 basis points on core PCE. And I think the lesson learned there was that, hey, if you're within 30 basis points of 2%, like you're good. Like you're pretty close.
Or that perhaps, the weightings towards each side of their dual mandate may not be equal, right? That we're much more comfortable with slippage around the inflation side of the dual mandate than they are with slippage around growth.
I did think it was so interesting that, to your point, last meeting there was the 2 dissents, and then this meeting the only dissent was Miran. And so I'm curious if there's anything that you read into that like, okay, so now you have the 2, Waller and is it Bowman were the 2 that dissented, that they now did not express that they wanted the full 50 basis point rate cut. They were like, okay with 25. I was curious, like, why you think they didn't go for that, because everything that I had seen was this idea that they are auditioning to become the next, chairman of the Fed. Obviously, when Powell steps down when he was probably not renominated next May. And I also had seen, there was a Bloomberg article today about Miran talking about like the Fed's 3rd mandate, like the goal of keeping long-term interest rates down. Is that anything that people put any stock into? Like, how are you guys looking at that?
Yeah, so on the first part of the question, Kristen, Waller and Bowman could have decided not to dissent for a long list of reasons. It could have been that they heard something in the committee discussions that made them think, okay, like maybe just going 25 bips at this meeting is the right thing to do. And we do get a lot of information over the next 3 months. So they could have heard something within the confines of that meeting that convinced them not to dissent. Perhaps they just wanted to show solidarity around the rate cut itself. That it's hey, we asked you for a rate cut at the last meeting, and now we're getting what we had asked for, and we just want to show support for the committee. But I think what will be interesting is what we get in the data set, and then how they react to it going forward. We only get one more round of economic data between this week and the next FOMC meeting. It would be surprising if the data that we got convinced them to do more than a 25 basis point rate cut. But of course, then there's revisions, and so the whole data set could convince them to move in a larger increment at the next meeting. But they probably will take their time to see the additional 2 rounds of data after the next meeting before they decide on making a larger move or perhaps dissenting again.
Right.
So that's how I would think about that. And then when I was growing up in the business, you always heard about the dual mandate.
Yeah.
And, I don't know, probably about 10, 15 years ago, somebody sent me the passage on the Federal Reserve's website that listed the mandates, and there was more than 2. There was a third one, and that kind of struck me at the time as being interesting. But yeah, the third part of the mandate is moderate long-term interest rates. And Powell in the press conference, addressed this, and he said, look, this idea that our third mandate is moderate long-term interest rates, that's the way it's written, of course, in the bylaws. But in the end, moderate long-term interest rates are a result of us achieving the first 2 parts of the mandate, maximum employment and stable prices. And that all makes sense to me. Moderate long-term interest rates. By the way, I should just note that moderate does not mean low.
Right.
Right? I mean, moderate probably means not high, but that's different than saying low.
Yeah.
And that's the other issue that maybe you want to discuss, is this idea that the U.S. Treasury Secretary wants a flatter yield curve.
Yeah.
This is something that people were talking about before the last election, because the Treasury Secretary, before he was Treasury Secretary, talked about bending the curve.
Yeah.
And I've always thought that this idea that the Treasury Secretary wants a flatter yield curve was just barking up the wrong tree. In part because at the time, and even today, the yield curve is pretty darn flat.
Yeah.
Now, when I say the yield curve, here I'm talking about from the overnight rate out to the 10-year yield, or from the overnight rate out to the 30-year yield. The yield curve is really flat, actually. So the idea that he wants it flatter than what it already is, it strikes me as being odd. But then the other issue is, if you just take the long term, let's take the 30-year bond yield, and you move it down 100 basis points. And let's say that's the only thing that you do, right? Is you move the 30-year yield down 100 basis points. How is that going to affect the economy?
Right.
And the answer is, it's not going to affect the economy that much, because one of the biggest parts of the economy, the housing market, does not key off of the 30-year Treasury bond yield. We think about the 30-year fixed rate mortgage. I know it says 30 years, okay, but I mean, that's not really what drives the 30-year mortgage rate. One of the things that we talk about in fixed income markets, and particularly the agency mortgage market, is this concept of partial durations. So without getting too wonky about it.
Oh, get wonky. No, we love it.
You can think about like a 10-year Treasury note has a duration, and the 30-year Treasury bond has a certain duration. The 30-year fixed rate mortgage that is traded in the marketplace doesn't necessarily have one fixed duration, because it keys off of different parts of the yield curve. So for example, the 30-year fixed rate mortgage that's traded in the secondary markets has a partial duration to the 2-year Treasury note. And this is measured empirically. So if the 2-year Treasury yield were to fall, the question is, how much would the mortgage rate move, right? So they calculate these partial durations. And as it turns out, the partial duration to the 30-year yield for the 30-year fixed rate mortgage is only about 10%.
That sounds high to me, if anything.
Yeah, I mean, and so, about 40% of the partial duration is the 10-year yield. And so what that means is that 50% of the partial durations for a 30-year fixed rate mortgage in the secondary markets is this 5-year note and the 2-year note. So really, I think if we were to accurately assess what Treasury Secretary Dissent wants, he wants all Treasury yields to go down, right? Like
Yeah.
it's not just the flatter yield curve, right?
Well, it's this theme that we've talked about here on the podcast previously over the past several months. It seems in the current dialogue that we're having across the political spectrum and also just, the pundits who get up on TV and talk about things and make recommendations. It sounds like we're continually asking for monetary policy solutions to fiscal problems, right? Wouldn't it be nice if rates were lower so we could now reduce our deficit by funding ourselves at much lower interest rates? Well, wouldn't it be nice? Okay, but like the two things are supposed to be independent or relatively independent of one another. That's not going to solve all the world's problems. We can sit here, I think, and argue till we're blue in the face about why we didn't term out our debt when rates were lower, right? Why we loaded up on front end bill issuance and 2-year notes and everything when rates were at zero. And I think there's an argument to be made for, okay, should we have strategically rebalanced our issuance during that zero interest rate period? But we didn't. We're here. And so I think the circumstances that would bring about lower long-term rates are a result of, I think there's almost this lull that we've gotten into. When we started the call, we talked about, again, I'd love to circle back to this, how your experience understanding Japanese rates informed the US. We've been in this period of time in the post-QE era where everyone basically thinks of the Fed easing as being hand in hand with quantitative easing. And the two, just a cut of rates, just normal day-to-day monetary policy, is a far cry from the bazooka of quantitative easing that we've become so almost numb to, in a way, if you will. And I think that that's what's informing a lot of these conversations, is that we've forgotten that this was supposed to be the nuclear arsenal that you only bring out in case of emergency, like break glass. So I wonder to what extent that has infiltrated everyone's thinking, that we take for granted. Oh, well, the Fed's just going to QE.
Yeah, no, exactly. I mean, I think pretty clearly the people on the FOMC would like to avoid having to use quantitative policies forevermore if they could, right? I don't think that they want to get back into that business. And going back to a comment I made earlier, I think if they had taken a deep breath when core PCE inflation was below its target by 30 basis points, maybe we would have never seen these quantitative policies, right? If they had just taken a step back and acknowledged that, core PCE inflation at 1.7% year over year is not the end of the world. Like, we don't need to double our balance sheet in order for another 30 basis points on core PCE inflation. Perhaps things would have turned out differently, right?
So are you saying we should never have QE'd ourselves out of 08?
No, I mean, at that point, right, we were probably facing a pretty deflationary shock. And so the initial rounds of quantitative easing, I don't think anybody would argue with, really. But it's as we got further into that cycle and it became clear that it was going to take a lot more to get inflation from 1.6% year over year or 1.7% year over year up back to 2, that it was those additional rounds of quantitative easing, including, let's say, the maturity extension program, that we probably didn't really need. Obviously, look, playing armchair quarterback is not the best thing to do. There's being on the Fed, I'm sure, is an extraordinarily difficult job. But I would say, I think if we were going to criticize the Federal Reserve for anything that it does, before we criticize its actions, I think we need to take a harder look at the mandate. Because again, if the Fed's mandate is to get inflation back to 2%, which, by the way, is not the mandate. The mandate is stable prices.
Yeah.
The mandate is not 2% inflation. They have interpreted it as 2% inflation meaning stable prices, but inflation was pretty stable just below the 2% target for some time. I mean, and I lived in, Jen, as you know, I lived in Japan for a decade, and I can tell you from firsthand experience, not having to guess at what your weekend is going to cost you when you go to the ATM. I mean, nobody goes to the ATM machine anymore, but like I used to go to the ATM machine, right? I mean, you guys did as well. And not having to guess at how much money you wanted to take out for a good weekend was really nice. It's like you knew what the price was going to be year after year after year. That was nice as a consumer.
Well, it's so funny because one of the things that, everyone was kind of waiting to see is the impact of tariffs going to be like showing up in prices in October and blah, blah, blah. And the thinking of it is like, well, but even if it did, it's a tax. So it's like the price would go up once and then it would be there. And then it's like, it's not going to be affected anymore. But the irony is it's like the uncertainty of the tariffs makes it so that there's like all this price instability and like nobody knows what's going to happen. So it's kind of funny that it's like, if you just put the tariffs in and then they stay, at least it's like a one-time shock, but then there's no more inflation from it versus like, we don't know what's going to happen. And it's like constantly waiting to see our price is going to go up. Like, are they going to, like, anyway.
Yeah, Kristen, I mean, you bring up a great point, which is this idea that, and kind of linking it back to Japan, in Japan, instead of doing these tariffs, many years ago, they actually raised their consumption taxes because they were getting a lot of flack for running these very large budget deficits, right? And Japan's debt to GDP ratio was the highest in the developed world. They were getting a lot of flack for that. And so they decided, okay, well, we need to raise tax revenue. We're going to raise consumption taxes. And, the market didn't worry about the inflationary impact of raising consumption taxes. Of course, the measured rate of inflation did go up, but people knew that would end up leading to less real demand. And, what we don't know about the tariffs is who exactly is going to be paying them and how much are they going to be paying. Like, we know that the exporter will pay for some of it, the importer will pay for some of it, and the consumer will pay for some of it, but we just don't know what those ratios are. But in the end, it is a tax, and it should slow activity in some way.
One final wrap-up question on kind of our quantitative easing conversation. When we were live yesterday with Gene, we asked about basically the Fed's QT program of shrinking their balance sheet and letting everything roll off. And we asked him, hey, is it kind of just a given at this point that they're going to basically end that at the next meeting? And he said, yes. I'm curious, do you share that view?
We do not think they're going to end the quantitative easing program at the next meeting, in large part because we're not seeing many disturbances in the funding markets. We're not seeing issues with funding market liquidity. Again, when we get to certain dates on the calendar, quarter end.
Yes, wait, I want to talk about this. We just got through September 15th. We did not have the repo apocalypse that we had feared. We were not back in September 2019. So you think that stresses in the funding markets are neither here nor there?
Yeah, at this point, that's right. We look at reserves in the system as a percentage of bank assets. They are, in our view, well above the levels that would cause us more concern. That's not to say that next year we won't get closer to kind of the level of reserves relative to bank assets that would start to cause some concern. And we do think that the Fed wants to avoid another kind of mid 2019 episode. I don't think that they were happy that happened. So they do want to avoid it. That means they're going to leave some kind of a buffer in the system, but we just don't think that we're close to that point yet. So we don't expect them to end QT this year or really even early next year.
Interesting. Ooh, I like that take. There's a decent amount of disagreement in the market on this issue. So I think that's fascinating. I feel like everyone's always so consensus on these things. So I like hearing both sides of the story. But back to, the current state of the US market, your most recent research piece on US rates favors the steepener. And I'd love to talk a little bit about that. We got this, I call it like a twist steepener, if you will, going into the Fed meeting, where first we had the bull steepener, where front end rates rallied as the market took in all of the negative labor data and said, okay, Fed's going, like there's no question about this, right? But then over the course of the subsequent weeks, we actually saw the long end sell off. And we were talking about that as a reaction to fiscal policy in the US. We were talking about learning lessons from Europe, all those things. Everyone was in the steepener. I think a lot of that was positioning. And heading into the Fed meeting, we saw a huge flush out through an auction cycle where the curve flattened again. And I saw your most recent research piece that said basically like, hang on to that steepener. That is the long-term trade that we like. It's a negative carry trade. And I'd love if you could explain for the average listener who may not be living and breathing interest rates all day, A, like why you like the steepener, B, the mechanics of carrying a negative carry trade and what that looks like in terms of the risk reward, and C, why you think that that recent flattening was maybe nothing fundamental to worry about.
Yeah, absolutely. So the yield curve is like if you could only look at one thing to figure out whether the yield curve in the US, really, the difference between the yield on a 2-year Treasury note and the yield on a 30-year Treasury bond, right? That is what you can generally conceptualize as the yield curve. If you only had to look at one thing to figure out if, that yield curve was going to steepen, so short-term interest rates go down and long-term interest rates go up, right? That would be a steepening of the yield curve. If you could only look at one thing, you would just look at the Fed. Because historically, when the Fed lowers its policy rate, the short-term interest rates go down more than long-term interest rates. And it's worth noting here that when the Fed is lowering its policy rate, you typically also see long-term interest rates go down. It's just that they don't go down by as much as short-term interest rates. And if we take a real critical view as to how the US yield curve has steepened in this cycle, that is exactly how it has happened. Now, on any given day, maybe long-term rates go up and short-term rates go down, or maybe on any given day, short-term rates go up a bit and long-term rates go up a lot. So that would be a bear steepening. So on any given day, lots of different things can happen, right? The curve can twist, the curve can bull steepen, it can bear steepen. But if we look at it kind of at a bigger picture level, what's happened to this yield curve is it has bull steepened, meaning the 2-year yield has gone down a lot. The 30-year yield has only gone down a little bit, or maybe not at all, right? So it has, in fact, bull steepened. Why do we like investors positioning for a steeper yield curve? It's because we think that as the Fed lowers its policy rate, the market will be pricing even lower policy rates in the future. Whether or not the Fed delivers on those policy rates that are priced in, the Fed may not deliver. But as the Fed's delivering the rate cuts today and maybe next month and maybe the month thereafter, we think the market will continue to price in more and more, and that will help the curve continue to bull steepen. On the carry, when we say somebody is carrying a trade, really you can think about it as the rent that you pay to hold any position in the market, right? It's like, well, I want to own this position. Okay, nothing in life is free. And it's like, how much are you willing to pay every day, every week, every month to hold that position? Well, guess what? Sometimes you get paid to hold a position. Sometimes somebody says, you know what? I don't want this. You take it and I will pay you to hold it. So when you put on a trade, you can analyze, am I going to get paid to hold this trade? Or am I going to have to pay to hold the trade? And in the case of the yield curve steepener, there are ways you can structure it such that you actually don't pay very much at all. And then there are ways you can structure it where you pay a lot. And so, we've chosen something that's kind of in between the two, because ultimately you get what you pay for, right? And if you pay a lot to have a trade on, you want it to perform very, very quickly, and you want it to perform very, very well.
Mm-hmm.
And, market timing is tough, and this is coming from, I mean, I've been a professional in the financial markets for, over a quarter century, which makes me sound old, but, like I have, that's just the truth. And, I've learned market timing is really hard.
Mm-hmm.
It's not easy, for professionals or for amateurs, right?
Well, I think, the specific, and correct me if I'm wrong, but the specific expression of the trade that you guys favored was threes bonds, right? It wasn't twos tens. It was threes bonds specifically. I assume because of that carry element that you were optimizing for like reducing the drag or the rent. I like that, that phrasing, paying as little rent as possible to get into that trade. I'm curious, looking at other expressions, why not express the view in swaps? Why not express it conditionally via a conditional bull steepener in swaptions, per se, something like that? And this may be a little more advanced than our listeners are used to hearing about. But again, like Matt said, there's a number of different ways that you can express any trade. Some of them are super balance sheet intensive. Others maybe involve spending a little bit upfront premium. Some involve paying this rent, like you talked about, vis-a-vis negative carry. I'm just curious, was there any additional analysis that led to expressing this view in treasuries rather than any of those other means?
Yeah, absolutely. So, if we look at the SOFR swap curve, right? So, your listeners can think about this as the curve that is pricing repo rates going into the future. You could express a curve steepener using the SOFR swap curve, but it will cost you much more
Mm-hmm.
in that rent and that carry than if you were to express the view in the Treasury complex. So that's number one. Number two is, if we were expecting a lot more Treasury issuance in the future, then, we might think critically about, okay, if there's going to be a lot more Treasury issuance, where is it going to come on the yield curve? And how might that impact the shape of the yield curve? But in this case, we're not expecting the US Treasury to increase coupon bond issuance until early 2027,
Mm-hmm.
which, for all intents and purposes is a lifetime away
It's a
from now.
million years away. Yeah.
Yeah. So we had gotten through the last US Treasury quarterly refunding where the Treasury decided to increase the pace of buybacks in the long end of the curve. So we weren't worried about there being some kind of, idiosyncratic US Treasury buyback related,
Mm-hmm.
shifting of the yield curve. And so we just thought, okay, we don't want to pay a lot to have this trade on, but we know we're going to have to pay something. It's all about kind of maximizing that decision, right? It's to say, okay, well, how much do you want to pay? How much do you think you're going to get for what you pay? But like, it's not worth paying something way above the market if you don't have to.
Yep.
And so that's how we thought about it.
We've talked a lot about interest rates. You are head of macro. I kind of want to talk about the bigger macro picture as well. I want to talk about what you think of, I mean, yet another day and equities are happy and on the moon and everything's great in risk asset land. I want to talk about equities and the dollar. So, obviously when we have a monetary policy decision, it's going to have a direct impact on both. I'm curious overall what your view is on the US dollar from here. It's been a rough year. We're hurting, and we now have easier monetary policy. So all else being equal, that should be bad for the dollar. But I'm curious what you think about the dollar and about the equity markets.
Yeah. So on the dollar, we came into this year calling the dollar down. And
You got it right.
that was very out of consensus. We were getting, interest rates were going up and the dollar was following US rates higher. And we began to call the dollar down. And then eventually the dollar went down quite a bit. But we think it's only about half of the way through the process of
Oh, good. Oh, yay.
Yeah, I know. I mean, look, I certainly don't take pride in calling for a weaker US dollar, but I mean, the dollar has been one of the strongest currencies on the planet for more than a decade. So, having it retrace slightly is not exactly the end of the world, but we do think that the dollar probably has about another 10% to depreciate, and it's already starting to make that move this
Yeah.
week. One of the drivers, of course, is that we think the market will reprice the Fed a lot lower.
Mhm.
So we think that can weigh on the dollar. There's a lot of talk earlier this year about hedging currency risk. And the issue is that to hedge the currency risk of owning dollars, it was quite costly earlier this year. But as the Fed begins to lower interest rates, we do think that this idea that it's costly to hedge your dollar exposure will become less and less of an impediment to
Mhm.
actually increasing your hedges. So we do also see kind of this tailwind for the dollar to depreciate coming from a cheapening cost of hedges. So that
Mhm.
that is one factor as well. Um,
And
on,
dumb
on
question, when you say hedges, like give us some specific examples.
Yeah, so imagine an investor outside of the United States who really wants exposure to the U.S. equity market. So they would, let's say, take yen. They would buy U.S. dollars, invest those U.S. dollars into the U.S. equity market. But then what they could do is they could do kind of a forward currency trade
Mhm.
and sell those dollars forward to buy back yen,
Mhm.
right? So in other words, they can hedge out the currency risk and just take the exposure to the US equity market.
Yeah.
But in hedging out that currency risk, that dollar yen currency risk, it was quite costly. I mean, it still is costly,
Mhm.
but it was even more costly a year ago. Well, the other angle on the equity market
Yeah.
that I would share with you is, I'm not the equity strategist for Morgan Stanley, but over the years, I've developed a macro framework
Mhm.
for thinking about, the price of equities generally, and you could also apply this to just risky assets in general, right? And it's a very old school cash flow discounting model called the Gordon growth
Yep.
model, right? And it's very old school, and I think it's maybe not super in favor, but it's because it's very hard to show empirically that it works. And but the idea is you have these future cash flows, and the question is, what do you discount them by? What interest rate do you discount them by? Well, the rate that you discount them by is the real interest rate minus growth expectations.
Mhm.
That's the idea, right? And so if real interest rates are going up and growth expectations are staying the same, then the discounting rate for those future cash flows are going up and the present value of those future cash flows is coming down.
Mhm.
But let's say there's an environment where the real interest rate's going up and growth expectations are going up. And let's say that they go up in equal measure. Well, what happens to that discount rate is it doesn't go anywhere because you take the real rate minus the growth expectations, R minus G.
Mhm.
That's your discount rate for these future cash flows. So if R goes up and G goes up by the same amount, then your discount rate's not changing.
Mhm.
Okay. And so that framework, I mean, all I can offer you is that for the better part of 15 years since I kind of came upon this idea, I see it in action all the time.
Mhm.
I can't show it to you empirically because there's no time series of data on growth expectations, right? Like
Mhm.
I can show you a time series of real rates,
Yes.
but I can't show you a time series of growth expectations.
Mm.
But when you're in the market and you're talking with investors every day, and at least you've got some amount of emotional quotient,
Mhm.
or emotional intelligence, like you can tell, are growth expectations improving? Are people becoming more pessimistic on growth? You can
Mm.
tell, right? So that's a good framework for thinking about equities. And if I apply that to today,
Yeah.
like real interest rates are inching lower and growth expectations are moving higher.
Mhm.
And that's why the equity market, I think, is going up.
I love that. I love a very rates-based approach to valuing the equity market. So I'll take it.
So
Okay.
maybe one other thing to offer you on Japan and just what I took away from my experience there, because
Yeah.
you mentioned that earlier. I read this book as I was living in Japan, and I was trading the Japanese government bond market for a while, and then I was doing research on the yen interest rate markets. I ended up reading this book by a man named Richard Koo, Koo. And he wrote this book called The Holy Grail of Macroeconomics. And it completely changed my perspective on Japan macro. But it also informed my perspective on macro in general. And the whole key to the Japan story, which he illuminated in this book very, very well, is that you can lower the price of credit, right? So interest rates, so you can lower interest rates, so the price of credit, but that doesn't have to affect the demand for credit, which is kind of this odd concept in macroeconomics, right? That you can lower the price of something, but the demand doesn't have to increase. And he was offering an explanation based on the Japanese experience as to why demand did not increase when you lower the interest rate level. And the answer was that these businesses in Japan, mostly the big commercial banks, they had these gaping holes in their balance sheet, meaning that they were structurally insolvent, but their business models were making money. So kind of like imagine a scenario where like you have this massive debt on your balance sheet, and you can't pay it all back right now, but every year you're making a lot of money. And eventually you'll be able to pay it back, but it will take a long, long time. And that was the story in Japan. And he made this point that because they had such a large hole in their balance sheet, when interest rates fell, right, the Bank of Japan lowered interest rates to zero, and they were trying to spur activity. Activity actually did not pick up because these companies were just trying to stay alive and make money and pay back debt. And so that was this concept, this holy grail of macroeconomics, that you can lower the price of credit, but the demand for credit doesn't have to increase.
Yeah.
Right? If these companies are worried about other things. So that actually informed my view as to what the US was experiencing after the great financial crisis. One of the reasons why I got the job I eventually got to run our US rate strategy effort is because I was a trading desk analyst, but I was also writing research or research-like notes. It wasn't research officially, but I was writing research-like notes that you would associate with desk strategy, right? And I was just very bullish on the Treasury market when most people were bearish, and I ended up being right on the call. And it lasted a long time. It wasn't just a one-year thing. It was a multi-year period where the US had experienced a balance sheet recession. So this is Richard Koo coined this term balance sheet recession for the Japan experience. I think in the wake of the great financial crisis, the US also experienced a balance sheet recession. But it wasn't a corporate balance sheet recession like it was in Japan. It was a household balance sheet recession. Because remember, like in the US, people were over-levered on housing.
Yep.
Yeah.
And then they had this massive hole in their balance sheets. And so that's why we had that period of time. Yeah.
So take us through your career a little bit, because backing up even further and zooming out, we talk all day to young people who are interested in getting into the business, and they're coming to us asking about very specific opportunities. You know what we don't get asked about, Matt? We don't get asked about fixed income research and strategy. And I'm just being brutally honest here. But when I came into the fixed income division of an investment bank, it was sales, trading, and research or strategy. And so I'd love it if you could walk us through your career path and then help us understand where strategy fits in the fixed income division, why it's different from equities research and strategy, which we've touched on before on this podcast, and how it relates to the other divisions within fixed income. Like, how do you interact with trading all day and sales? How do you guys bring in revenue? Like, what's the business model? And so a big task, I know. Let's start with just your story, and then we can use it to illustrate various points along that.
Yeah, absolutely. So I joined Morgan Stanley, 25 years ago as a Japanese government bond trader. And I wanted to join the financial world as a trader because it seemed like it was fun, and it seemed like it was the highest paying job on Wall Street.
And it was.
And yeah, maybe back then it was probably close
Yeah.
to one of the top paying jobs. But what I learned in those first 2 years was that, trading, I don't think was a great place to start. Part because your mentors are busy during the day trading and not mentoring you, right? And so in general, I think in the financial world, you learn by osmosis, you learn by observation, you learn by self-study. Occasionally you get to squeeze in a question, but at the time I didn't know any of that.
Well, and in trading, you're learning how to shoot on the battlefield. It's not like, okay, you get to go through, that's it, right? You're plugged in that seat day one and you're trying to figure it out as you go.
Absolutely right. So, during those first 2 years, I self-taught myself what I could. But then, I got a call from one of my analyst classmates. So, lesson here is keep in touch with your analyst classmates because they can provide you lots of different opportunities that you wouldn't have thought otherwise. But I got a call from one of my analyst classmates, and he said that there was a role on his desk in research that was opening up, and he wanted to know if I wanted to interview for it. And it was in New York. I thought it was in New York at least. So I interviewed for it. I got the role. And then I got a call saying that actually the role was not in New York. And I was in Tokyo, Japan at this time. And so I learned that the role was still in Tokyo, and that the head of the US interest rate strategy team was going to move to Tokyo to learn more about the Japanese markets because he was going to become the global head of interest rate research. So he and I were working very closely together for about 2 years, and he was a fantastic mentor. He taught me almost everything I know about interest rates, even today. A fantastic guy. So I did that for 2 years, and I was working really hard. I was in the office at 6:30 every morning. I was going home at 11 p.m. every night. The work-life balance was not a concept back then, like it is today. And I'm glad it's a concept today. I think it's unhealthy to do what I did, but I did it. And after 2 years, I burned out. And I thought, I learned so much from working as hard as I did and from my mentor, my boss, that I thought I need to apply this knowledge back in the trading markets. So I raised my hand and I wanted to get a trading job again. Here I moved to New York, and I got the role to make markets in Treasury inflation protected securities tips. And it is, I think, by far the worst market making job on Wall Street.
It is. I mean, that seat at most firms, there's like 5 people who trade tips on the street, right? Everyone knows who they are. They all know each other. And then below there's like a revolving door, right? Because it's like either you're one of those 5 guys or you're just, it's so hard. And it's just such a niche product with zero liquidity. And like, if something goes wrong, it is just a unmitigated disaster.
Yeah, you need to have a management that is going to support some big drawdowns.
Yeah.
You really do. Like you need trading management, and not just trading management. You need firm management to be supporting very big drawdowns on occasion, right? Obviously not every year, but we didn't really have the bandwidth to do that or the wherewithal to do that. So I spent 2 years trading tips. It was a good experience in that it taught me that traders do not always get paid very much money.
Did you trade inflation derivatives as well, or just cash?
No, just cash.
Just cash. Okay, got
it. At the time, U.S. CPI swaps were just developing, and they were really more traded off of our London inflation desk, because at that time, Euro inflation swaps were very liquid and traded quite a bit. So, but you get paid a lot as a trader if you make a lot of money. If you don't make very much money as a trader, you do not get paid a lot of money. Okay. And
what year was that, by the way? Because then there was
2005 to 2006.
Right. Yeah. I was going to say, because back then even you got paid a really ton of money if you did well. Now it's a little more capped because of the whole no prop trading thing, but yeah.
That's right. That's right. And the thing is, the thing about that part of my career is I did what they told me to do. Like I increased our market share. I didn't lose much money at all. But at the end of the year, because you didn't make money,
Right.
you don't get paid. And so I thought to myself, well, I don't like this very much. And so they came to me, but I worked really hard. I've always worked extraordinarily hard during my career, and they saw that, and so they said, well, what else can we do with this kid? He works really hard. This is clearly not the right seat for him. What do we do with this kid? They came up to me and they said, hey, we have an opportunity back in Japan. I mean, bear in mind, I had just moved to New York like 2 years earlier.
Oh my God.
And they said, we have an opportunity back in Japan to help run our agency mortgage-backed securities franchise in the region.
Okay.
I was like, okay, this is interesting. Like, it's a different product. It's a product that has an element of interest rate markets in it. It's got a product that has an element of something totally different, prepayments. So I get to learn something new. And at that stage in your career, you're not even 10 years in. Like, the goal is to learn as much as you possibly can learn. And so I get to learn something new, and I love Japan.
Well, I was going to ask, what is the reason that you went to Japan in the first place?
My parents were transferred to Japan with their careers. They worked for AT&T Bell Laboratories. They were both computer engineers and in management as well. And so they were transferred to Tokyo. And as a 17-year-old, I went with them. And it was fantastic. Japan is a fantastic place to live and work. So the opportunity was to go back to Japan and be what in the US you would call the overnight person, but basically the person that was meant to build our agency mortgage-backed securities franchise in Asia. So I did that, and it was wildly successful. I traveled all over the Asia region, met with all different sorts of investors. But about 3 years into that role, we had the great financial crisis.
Yeah, you were trading agency mortgages in like illiquid time zones. It must have been interesting.
It was, well, I mean, like what ended up happening is that investors in Asia stopped buying them. So I was sitting there trying to figure out what I was going to do every day because nobody was active in the overnight session in mortgages. And this is like a part of time in one's career where you have to just realize that unless you're adding value, you're going to be shown the door.
Yeah.
And I had to figure out how to add value. But I also wanted to do something that I wanted to do, right? And I really loved rate markets. And so I started writing effectively research notes, but of course they weren't research because I wasn't in research. I started writing research-like notes and sending them out to the clients in Asia.
Yeah.
Just the clients in Asia that I would meet all the time. And salespeople started getting a hold of these notes, and then they started forwarding them around. And the next thing I knew, I was having investors from all over the world, from Europe, from the US. I mean, here I'm still based in Tokyo, right? And I had all of these people just emailing me saying, hey, I saw this note that you sent out. Can I get on your distribution list?
Oh, wow.
And 3 years later, I think management, trading and sales management in New York realized that we have a US rate strategist sitting in Tokyo who's not a US rate strategist. Like, why don't we just make him the US rate strategist? So then I moved to New York again. and that kind of kicked off my next stint in research. So I was head of US rate strategy for about 18 months. They then made me global head of rate strategy. I did that for about 6.5 years. And then in 2020, just before the pandemic, they gave me responsibility for all of our foreign exchange and emerging market research. And then it was baptism by fire after the pandemic. I mean, I had to learn about currencies during what was probably the most exciting time in currency markets for a long time. And my first big currency market call was to sell the US dollar when the only thing that people wanted on the planet were US dollars. right? This is
When
the
was this?
pandemic.
Was this 2020?
Yeah, March, April 2020. I think we went out with our short dollar call in April of 2020. And you can go and look at a chart. Like it didn't go
Oh,
down immediately, but and I was, here I am. I'm a rates guy.
yeah.
And all of the FX salespeople were like, why do we have a rates guy running FX research? And when I came out with this short dollar call, the criticism, kind of that the silent pushback, the how, like, see, I told you, we've got this guy who doesn't know anything about currencies coming out with this massive call on the dollar when all of our clients just want to buy dollars. And I ended up being right. So that was my baptism into the FX space.
I love that.
So
So,
cool.
what I'd love to understand a couple things. You talk about like sales and trading's reactions to research and strategy. First of all, like dumb question. What's the difference between research and strategy? Like, is there one? Is this just like a, nomenclature thing? Is there any difference there?
So yeah, there's a couple of things I'll say. It depends on the firm.
Mm,
So and it depends on a word you may put in front of strategy. So if you say desk strategy, then you're talking about an analyst that is not within the research department, who is sitting on a trading desk or close to a trading desk, who either works for the sales force or works for the trading desk. And the idea is that that person is supposed to analyze markets and come up with ideas that help the desk get out of positions or get into positions that they want.
mhm.
Or it's just to help the sales force do more trades, right? So it can be one or the other, it could be both perhaps.
Are
But
you
that was
suggesting that the sales force isn't just generating all these brilliant trade ideas on their own and pitching them to clients?
I mean, I've met a lot of salespeople that could be in research tomorrow if they wanted to, right? I mean, everybody in this business is really bright. But I would say, that's the desk strategist. Uh,
Someone I would have loved to have had, by the way, back in the day. That is someone whom I would have benefited from massively as a salesperson. So I say that in jest.
no,
Uh,
very good. But then there's, I like to call myself a strategist, in part because I am a strategist. And in the FINRA nomenclature, I am a strategist, right? I'm not an economist. I'm a strategist, and I'm not an equity analyst. Okay, so they're all sort of different, but the difference between strategy and research within the research organization, I think, is just one sounds boring and the other sounds exciting.
I love it.
Strategy to me sounds more exciting than research
right.
sounds.
Yeah.
I totally agree. I couldn't agree more. And so then within the framework of the firm, you talked about like, hey, the sexy thing about trading was like, if you did well, you got paid a lot of money. If you're the best strategist or the worst strategist, right? There's no P&L necessarily tied to your name from the trading desk. So how do you prove that you are adding value? You get your call right, you get your call wrong. You talked about being the Monday morning quarterback. It's like, okay, well, you weren't taking risk. So how do we prove that that added tremendous value? By sharing this information both internally and with our clients.
Yeah, so a couple of things I want to say. The first is the lesson that I've learned is that, if you want to maximize your lifetime compensation, trying to be a trader, if you are not a good trader, is not the way to do it. The
This is,
way
yeah.
the way to maximize one's lifetime compensation is to do the thing that you are best at and then
Yeah.
become the best at it,
Yeah. I love
right?
that.
Like if you are a top 3 strategist on the street, you are going to make more money than the average trader is going to make.
I love that. Oh, that's great. I want to understand kind of what the interaction is like between, both the trading desk, the sales desk, and clients. Like, what do you do all day? So you're publishing pieces, you're coming up with trade ideas, you're making those recommendations, you're on the phone. Walk me through just like the average interaction. How much does trading come to you and say, hey, listen, what do you think about this? How often are you going to the trading desk and saying, well, what do you guys have on, right? Like, what do you like here? How much, interplay is there and how much are things walled off? Because again, a lot of people are coming to this with an understanding from the equities world, which is so different.
Yeah, so I think of the research organization as being the ultimate customer service business within the firm, right? We have customers everywhere in the firm. We have customers outside of the firm. An institutional investor is a customer of Morgan Stanley Research. A financial advisor in our wealth management business is a customer of Morgan Stanley Research. Fixed income management is a customer of Morgan Stanley Research. Everybody is our customer. So it helps that I spent a long time in Japan. It has a great customer service culture that's really a part of who I am. So we interact with everybody as often as they want to, or as often as we have the bandwidth to interact with them. And our interactions, it depends. Oftentimes when you're dealing with firm management or research management, the interactions are related to the stress tests that the Federal Reserve puts on all of the banks. And so we consult on stress testing scenarios. When I'm talking with fixed income management, they're asking me questions about, hey, there was some event that happened in this market. We have a position in it. I want to better understand what exactly is going on in this market. A good example was when the Treasury bond basis was doing its thing, as it does, right? And when it was blowing out, we were getting a lot of incoming on the Treasury bond basis. Like, hey, what's going on in this market? How is this working? What do we think? Where do we think it's going from here? So we'll do a lot of those types of interactions as well. We will interact with the trading desks and the sales force within the fixed income division to explain to them how we're thinking about the market, how we're analyzing certain events like the FOMC meeting this week. So we do a lot of interaction like that as well. And then, the client interactions vary quite a bit, because to be a good strategist, you have to be able to interact with all sorts of investors. You have to be able to interact with a hedge fund portfolio manager that only cares about relative value,
Yep.
all the way to a central banker who just cares about whether, like the 5-year note is going to be going up or down in yield. So there's all sorts of different types of investors that we have to interact with. It kind of requires a breadth and a depth of knowledge when you get to my level.
I want to ask quickly, how much of, because so much of what you guys, or with rates, like so much is understanding monetary policy and economics. And I know you did study economics in undergrad, you said, but like how much of what you learned in undergrad was helpful to the job that you are actually doing now, and how much of it was pure osmosis?
So I think the skills that you develop during your academic life are really the critical thinking skills, the questioning, the ability to kind of look at a problem and try to find different angles from which to approach it. Yeah, the reality is that, when I was learning economics, it was still heavily based on kind of gold standard economics. And that's just not the way things tend to work, right? For example, like back then, we weren't learning about modern monetary theory. And, modern monetary theory gets a lot of bad press, I think mostly because there is a social element to modern monetary theory, right? This idea that, hey, if everybody wants a job, we can give a job, like the government can give a job to everybody who wants a job, so we should just do that. Not everybody agrees with that sort of social philosophy, but modern monetary theory is not just a social philosophy. It's also, it really is a philosophy about T accounting. How do T accounts work? And if T accounts are a thing, and guess what? They're a thing. Then like, how do we think about deficits in the context of a T account? And when you start to do the numbers on this stuff, what you end up realizing is that, there's nothing inherently wrong with deficits. You can have deficits that are too big and accelerate too quickly, because that can drive a demand impulse that ends up causing inflation to be higher than you would otherwise want. But there's nothing inherently wrong with deficits. Deficits can be used for the betterment of society. Like going back to Japan, right? Japan has a shrinking population, right? In the absence of higher deficits over time, you will have negative potential growth in Japan, right? Like you will have a very bad economic outcome in the country of Japan if they don't somehow find a way of reversing that demographic trend, or they don't use deficits to help stimulate the economy. I don't think anybody would argue against deficits if the alternative was depression.
Yeah.
Right.
And so just to piggyback on what Kristen just asked, for young people who are coming into the business, who are suddenly hearing this and saying, okay, wait a minute, like this actually sounds like a great place to start my career. What qualities do you think behoove young candidates coming up into fixed income strategy? It sounds like intellectual curiosity and kind of the rigor to be able to do in-depth analysis is important. But are you mostly looking towards economics majors? Do you think people need higher degrees? Are you looking for people who are, say, MBAs or have PhDs or masters? What does the typical candidate coming up look like who's successful?
So my number one piece of advice is to learn Python.
Really?
Yeah,
Even with AI?
Well, yes, because even with AI, right? Like, you can ask ChatGPT to create a Python script that does XYZ. But it's like with any language, right? Like unless you can read it, how do you know what it's telling you?
Yeah.
You need to be able to read it. I mean, yes, I mean, ChatGPT can write it. It can probably even speak it. But like, you have to be able to read it or understand what it's saying. So my number one piece of advice is learn Python.
Interesting.
Like MATLAB, which is what I was using in college,
Me
or
same.
right, data. I mean, nobody uses that, right? So learn Python, because in this world, data is ubiquitous, but interpretation of data is a real skill. And you have to know how to bring in the data, manipulate it. And the data sets are so large now that, Excel isn't going to cut it. So you really should be learning Python. So I would be looking for programming skills as being important. One of the junior people on the US rate strategy team came to Morgan Stanley from the University of Tennessee as a computer science major. And he's fantastic. Okay. He's doing a fantastic job.
How much would you say then that you prioritize those real quantitative and comp sci-esque skills over what I would traditionally think of as coming into research being a priority of effective communication, storytelling, being able to put together a compelling narrative?
So really what you're getting at there, Jen, is the life of a strategist, right? At my level, you need to be able to communicate effectively, right? You need to be able to hold a room. You need to be able to frame an argument. And you need to be able to offer a different perspective instead of pushing back. I do not like the word pushback. It just sounds aggressive. It sounds physical, like, hey, don't touch me, right? Like, I don't like the word pushback. So like when I'm in a client meeting and a client challenges me on something or says something that I disagree with, I will say, let me offer you a different perspective on that, right? Or let me offer you my perspective on that. It's a softer way of challenging somebody without trying to be abrasive or coming off as pushy. So, those softer skills are more important at my stage. But, as a first year analyst in the research department, it's really about number crunching and about asking questions, which it's so the irony in the life of a person in our business is, it's today I ask questions all the time without a second thought because I'm senior and I just want the answer, right? Like, and nobody's going to judge me for asking questions. So I ask questions like no tomorrow. I understand what it's like as a first year analyst asking questions. You feel very vulnerable. Like, hey, if I ask this question, it tells who I'm asking I don't know the answer.
Yeah.
But guess what? They don't expect you to know the answer, right? Like the expectations are different. I think just the ability to be inquisitive, it's like office hours. I mean, I did very well at Vassar. And one of the reasons I did very well is because I just developed this resilience to go to office hours, go to my professors, get to know my professors, ask questions. And now, like when you go on these TikToks about college, like my daughter is going to college next year, the advice is go meet your professors, get to know your professors. Like, yes, like that's great advice, and so it's really important for somebody to have the ability in their first year as an analyst to schedule some time with the MD and ask questions and prepare, obviously, but ask questions. That's a really important skill.
We get asked all the time about exit opportunities out of different parts of the firm, different career paths. Kids these days are obsessed with it. We talked before the call about a mutual friend who exited from research and strategy to trading, portfolio management on the buy side. What are the typical exits that you see?
So, I mean, individuals will move from research to a hedge fund, usually as a research analyst to start. They will move to the sales desk. They'll move to trading. They'll move to structuring, or they'll move to a different buy-side opportunity. It really spans the gamut. I think the great thing about research is that you can go anywhere. I think research is the best place to start your career. Obviously, that sounds like a biased comment, but I really do believe it's true.
You didn't. I mean, you didn't start your career there, and it sounds like you wish you had. So I can totally understand that.
That's right. That's right.
And a lot of firms used to make it mandatory to do a rotation through research before you could be in sales and trading, by the way. So like I would be all about bringing that back because I think then you learn the fundamental analytical skills to then be able to talk about these products rather than just winging it and being like, well, I guess that's how a bond works. We'll figure it out later.
Absolutely.
But we appreciate you so much, Matt. I'm so glad we got to reunite. Thank you so much for your insight on the Fed, for walking us through. This is our fixed income research and strategy 101 episode as well. So we're so excited to have you on. Give our love to the family, and you're in Tokyo right now, so please get some rest. Is it?
All right. Okay.
Oh gosh.
Thanks, Jen.
Thank you so much.
Appreciate it.
We really appreciate you. We'll talk soon.
All right. Take care.